Hi, this is Keith Schneider, CEO of MarketGauge.com, and this is January 25th edition of Market Outlook. So, may you live in interesting times, and it certainly is interesting. Lots of stuff going on overseas um, regarding the ECB, Draghi, huge liquidity injection, and its effect on the market. So let's get into this right away. First of all, the S&P is going to be an important tell early next week. Why? Well, in response to the announcement by Draghi and the injection, U.S. equities markets, and along with equity markets all over, had a pretty good rally. However, on Friday, it paused. And during this pause, look what we have here. Number one, we actually moved to a positive phase where our 50-day is rising well above the 200. However, we also just had a return move to the trend line from which it broke down from, the S&P. This is going back to October lows. So you definitely broke the trend line, came back, return move, but all these factors are all coming into play here. And with this inside day, if you fail the lows, you'll also be failing the 50-day moving average, putting it back into a weak warning phase. On the other hand, a move above the highs of Thursday could propel this thing and give it enough juice to get through the new highs as well. So to me, the big tell, the inside day and which way it breaks from is going to be really important next week. Let's take a look at some of the other market internals as well here. Number one, the VIX, basically holding its 50-day moving average. And as you can see, for the first time since in quite a while, the 50-day moving average has moved up over the 200 in this VIX indicator, and we're holding the 50-day moving average. Now, as usual, one of our ways we use it is if it gets a little bit frothy and moves outside of the 20-day Bollinger Band, it's often an indication that the short-term panic is over. But meanwhile, we've been overall holding at a higher level, even though the market has basically moved to new highs. So the relative performance of volatility suggests a underlying nervousness in the market. And again, that's also, interestingly, at a critical level, just like the S&P. So obviously, a move down through that 50-day moving average would coincide with a breakout to the upside above the 50-day and the Thursday high that was put in the S&P. Let's take a look at the short-term volatility versus longer term. You can see we got oversold early part in the year when we hit under the 1.0 ratio. We now moved above it over the last couple days, which gave us a clue that the short-term pressure on the market had abated. And now we've also moved above this green line here, which is above the moving average. So overall, in terms of overall panic mode, seems to have subsided and moved into a more positive phase. Let's take a look at the McClellan Oscillator. McClellan Oscillator, basically since the middle of December, generated a positive buy signal. It's had a nice rally off of that, since it has consolidated, and basically we're in relatively neutral range. Now, let's take a look at a couple of other things here as well. Number one, I wanted to focus on Russia. Obviously, lots of pressure in Russia, big flight of capital out, but if that's going to abate, let's take a look at this here. As you can see, you can pretty much draw in a horizontal line here above 1640 you would be taking out well over a month's worth of work. And on the flip side, let's put in this trend line right here off the lows, and you can see critical support really comes in around the 10-day moving average and a breakdown of that 15 level, which would probably mean a much lower move for Russia to the downside and continued pressure and uncertainty in the global markets. On the other hand, if this abates, we'll be in a better scenario. Now, I wanted to also point out the calendar range for Russia as well. So the calendar range that we follow is both the 6-month, which starts off the first 2 weeks of January, and interestingly enough, I'm going to blow this up here so you can see it, is that with Russia, the calendar range, the January to July calendar range, you've been trading above it the last couple of days. So you got a little bit of a relief rally here. If we can get above that 1620 to 1640 level, you could see a smart rally. And again, that would probably coincide with the overall pressure on the equity markets subsiding and with it being resolved to the upside. So that is Russia. Now let's just go back to junk bonds as well and take a look at those calendar ranges and see what they're showing here as well. So similar type pattern. You've got a lot of pressure here exerted. You're trading under this green line, which is the high of the January calendar range. And again, if we can get above that 39 level now, maybe even about 39.30 or so, that would clear and also signal that the pressure on junk debt is abating. So those are two important tells. Okay, so let's take a look at bonds here. On a weekly basis, you can see that this is the lowest in terms of interest rates that we've been on the 20-year bonds. Actually, we've traded out to new highs. But taking a look at the daily chart on bonds, you can see we basically moved in this sideways consolidated action for about a week and a half or so, about 6 or 7 days. So very important support right down to that 132 level, a breakout above the all-time highs would take out all of this compression in here, and that's over 135.50. Let's take a look at the calendar range on TLTs as well. So what's interesting on the bonds is that the January calendar range effect also coincides with those all-time highs as well. So if we can get above that 135.50 level, maybe just a little bit higher to clear the all-time highs, this thing is in pretty much parabolic mode and shows no signs of abating. But let's look at something else about where this overall pattern might stop. And interesting here is a monthly chart that I put up on TLTs. And you can see that there's this long-term channel which basically gives you an upside count somewhere around 155, 160. However, a shorter term channel line really takes place around the 145 level or so, just above here. You can see that is the upper end of the channel. So you've got a more accelerated channel to the upside, which is the outer bounds of it, which you can really expect to see somewhere around that 160, 155 to 160 level. But there's also some upside resistance on the upper end of a shorter term channel that started back, in 2009, as opposed to going back years and years. So essentially, we've got some upside resistance pretty much around the 140 level or so. So right now we're trading around 135, and that should give you some additional upside potential for this this setup. Let's talk about gold. Gold broke out of a critical trend line, longer term trend line. Remember, we had been focused on gold and have been in it for some time. Once it really swung above the 100-day moving average, we actually got in around the 116 level and are still holding a portion of our holdings. But we're looking at key levels as the calendar range comes in around the 120, 180 level. Also, important support comes in if the market sells off to hold this 200-day moving average, and that gap would be really critical. So somewhere around the 120.40 level to just under 120 would still hold the breakaway gap. That would be a natural point of a correction. On the other hand, we're basically holding the trend line that it broke out of over the last couple days. So gold is definitely in play. As I mentioned, it's important to note that gold has moved up, spectacularly already this year, and it's not surprising as capital is looking for alternatives to the euro, to the ruble, and looking for relatively safe haven. So that's why you're getting that huge move in the dollar, as well as gold, bonds, things like that. Let's take one last look at UUP, which is the dollar, and you can see it's just going parabolic. Now, with these type of moves, it's pretty hard to say where it's going to stop. From my experience, and it's fairly extensive, watching these type of bubbles, there's just no telling where they can go. And so at this point, you're looking at short-term price action that will determine tactics, and obviously trading from the long side makes following the trend the correct thing to do. On the other hand, to be flexible enough and watch to see if there's actually a blow off top that might be tradable. So complete flexibility here until further notice. You're looking to buy potentially a weakness and strength if you're not already in the dollar. Okay, that's it. I think this is a pretty good overall perspective. I really hope it helps. See you next week. Bye for now. This is Keith Schneider, CEO, MarketGauge.com, saying have a great week.